Sonal, hi, good to be speaking with you. The 6.5 figure for Q2 GDP, is it closer to your expectation as well?
Yeah, morning. We think it'll be closer to the lower end of that range. So we are expecting Q2 at 6.3%, so slightly below consensus expectations of 6.5 and also below RBI's forecast of 7%. I mean, in particular, we've seen, in our view, we are likely to see a bigger drop in private consumption. Even fixed investment, where we saw government spending pick up, our view is the private side of investment, things like construction activity indicators have been quite soft. And of course, we've seen profitability in some of the big manufacturing companies come down, which is also going to weigh on growth. So on the whole, domestic demand contribution to growth, we think will be softer than expected.
What does it mean to your overall estimates for the entire year? Is that at risk as well?
Yes, we think so. So our full year estimate is 6.7% for FY25. First half, is already tracking much lower. I think the big question is to what extent first half is sort of a transient slowdown and things will revive. Now, there are certainly things that look better in the second half. Government spending should pick up compared to first half, particularly on the capital expenditure side, and better crop prospects that also does bode well for agriculture production and rural demand. But in the overall scheme of things, we do think that India is dealing with tight monetary policy, tight credit policy, tight credit conditions, and now tight liquidity conditions. And you have the external environment looking a lot more hostile. So we see downside risk to our forecast of 6.7%.
Downside risks to the forecast coming in for full year as well. Very good morning to you, Sonal. This is Cheryl also joining in the conversation. In the backdrop, I wanted to understand what exactly are you penciling in for the inflation, because yes, you also had the RBI governor who had indicated that for the month of October we would see an elevated number when you talk about the CPI inflation print. But what are you penciling in for CPI trajectory going ahead for India in particular?
Well, we think inflation, has peaked. I think the October reading of above 6 was a surprise. But, I think the one clear trend we've seen in the last 12 months is this big divergence between food prices and core inflation. The trajectory on core remains quite benign, and all indicators point to both goods and services core inflation remaining low. Now, on food, some early evidence of veggie prices correcting. Edible oil prices are still elevated, but probably we'll see some correction on that in the month of December. And as the Rabi sowing picks up, we should start to see some moderation in wheat prices as well. So a moderation in food inflation, which has been quite elevated, is likely, along with lower core inflation. So we think the trajectory is down. Now, for the full financial year, though, given the upside in vegetable prices, the full year projection is tracking somewhere in the 4.6 to 4.8% range compared to 4.5% that the RBI had given in its previous guidance.
So what does all of this mean for the impending embassy meet in the coming week? And I ask you that because when we've been speaking with experts, you probably just heard Rama Bijapurkar talk about how incomes are something which is saturating a bit because I guess the public infrastructure spend was a bit lower in the first half of the year. Or when we spoke with Mr. Mariwala, who said that there is definitely a problem where consumption has stagnated and the RBI or the government will have to do something to loosen its string and purses with respect to that. Given all of this, what's the expectation for the second half of the year when it comes to public expenditure as well as the rate action from the RBI? Still a shallow cut, or it could be a bit deeper looking at the problem?
I mean, big picture, our view is India has entered a cyclical growth slowdown, and typically this tends to last for 6 to 12 months. So our view is risk to growth is to the downside, even in the second half of FY25. And there are a few factors that are at play. One is, as you said, consumption is moderating. I think the pent-up demand post-pandemic, is behind us. We are seeing a moderation in income growth and the tighter credit availability in terms of consumer credit because of the macroprudential tightening. So that's weighing on consumption. And when you have softer consumption, the incentive for firms to actually put up capex goes down. And a lot of companies are also facing the pressure because of these, imports coming in from China. So that's weighing on investment. And third is really on the external side. Trade volume growth, we think, is going to be softer because of increased uncertainty. So I think the risks to growth are clearly to the downside. And the inflation outlook, in our view, the food problem is actually fairly concentrated in certain buckets. Bulk of the CPI basket is very well aligned to the RBI's 4% target, and we don't see any signs of second round effects. So our view is that monetary policy is tight and needs to ease. Now, the comment from the RBI still appears to be on the hawkish side. So the base case is that the RBI stays on hold next week. But the extent of growth sacrifice underway, in our view, also means that it's going to be a deeper rate cutting cycle. So we have 100 basis point in total cuts in 2025 in our baseline. I think the other thing to watch is what's happening on liquidity. Because of the FX intervention, banking system liquidity has tightened, and the central bank needs to reverse that tightness, given we are in neutral stance and given the impact that tight liquidity has on the growth outlook. So some measures to ease banking system liquidity could potentially come through next week.
Given the fact you are saying that next week it's going to be a bit of a hold, do you think that could mean that the cycle of cyclical slowdown that you said typically lasts for 6 to 12 months, could it be longer? Could it be a little too late that perhaps RBI would have acted that deep rate cut cycle that you talked about of 100 basis point? Could that mean that there could be a deeper slowdown which could extend more than 12 months?
That is, definitely possible. We know that monetary policy works with a lag of 3 to 4 quarters. So anything we do today is actually going to have any, impact in the second half of FY26. So, we do discuss FY25 a lot, but as you said rightly, a lot of this is going to spill over into FY26 as well. So along with the downside risks we see for FY25, we do think that there could be downside to FY26 growth projections as well. We currently have a 6.8% for FY26, but that is also, potentially at risk of seeing downside because of these moving parts in terms of softer consumption demand, what it means for investment and the external environment we are in. Therefore, we do think a course correction on monetary policy is the need of the hour.
All right, Sonal, so you are expecting a further downside. You said the risk to the growth is on the downside, and if this also continues, would that make you also go ahead and change your growth forecast further, or cut your growth forecast further for the India growth? 6.7 is what you're estimating at this point in time, right?
Yeah, we have a 6.7 for FY25 and 6.8 for FY26. So one way, I think let's see what today's number brings in terms of the details. Second, the post Diwali, to what extent there is a rebound or not is something we are monitoring as well. And third is in terms of policy action from the RBI is also something will be an input into our forward view. And finally, I think the global outlook in terms of Trump 2.0, what kind of tariffs are imposed or not, the timing of that, and what that means for exports and global growth is something we'll need to incorporate as well. So yeah, we're watching all those things, but as I said, the way things are panning out, we definitely see downside risk to both FY25 and FY26.
So we leave it there. Thank you so much, Sonal, for joining us on ET Now to talk about the growth prospects going ahead for the Indian economy. Remember that this evening at 4 p.m. is when you will get the Q2 GDP data. What we are expecting, 6.5% is where the GDP growth for Q2 could be. But let's wait and watch what that number is.
If you like this video, then like, share and subscribe to ET Now.